And so a defined contribution approach has a transparency issue in the sense that it is very clear how much this costs, and it allows for an easy comparison of benefits paid to public sector employees versus private sector employees. And that's what we do want to know. Is there equity between the two sectors? So you can think about a pure DC plan, a state like Alaska and Michigan have shifted to sort of a 401k type approach for newly hired employees. In the paper, I talk about ways you can improve on the 401k model. 401ks have gotten a bad rap. Some of it's been deserved, though, that often, I mean, a big issue in terms of 401k plans is that they're not universal. That a defined benefit plan, if you're working for the employer, you're signed up for the plan. That means everybody's going to get something in retirement. With a defined contribution plan, they're voluntary. So a lot of people simply fail to sign up. Sometimes they just forget. Other times they say, oh, I need the money for something else. Then they get to retirement, they don't have enough. But there's reforms designed to either make it universal, to automatically sign people up. There's a variety of things that have been done to 401k or defined contribution plans to improve them. And I think there's a way, particularly with the state government, that can work on a large scale of making model plans that really will work very well for people. A second option is a cash balance plan. A cash balance plan is like it has some elements of a defined contribution plan in that your benefits are based solely on the amount that's deposited into your account. But unlike a 401k where you choose the investments and you take the risk, a cash balance plan offers a guaranteed rate of return on those contributions each year. So technically it's a defined benefit plan because the employer is taking the investment risk. For example, the state of Nebraska has a cash balance plan for its public employees, and that gives them a guaranteed return of 5% per year. In good years, there's a chance they can do better than that. Now, there's still a subsidy there. There's still this sort of accounting issue in the sense that they're guaranteeing people a rate of return of 5% on their contributions, when if you go out to the private markets, the highest guaranteed return you can get today is around 3%. So they've got an issue there. But with the cash balance plan, the fact that you're making this guarantee transparent, it tends to make them moderate the guarantees. With a public sector pension plan where you're assuming an 8% return on an investment, the way the math works out is, in effect, what you're doing is you're offering the participants in the plan, the employees, a guaranteed 8% return on their contributions and the employer's contributions. And that's just sort of the math just works out that way because the contributions go in, the contribution level is based on an assumed 8% return. So on average, the participants are getting an 8% guaranteed rate of return at a time when the highest rate on treasuries is around 3%. So it's a very, very generous approach. If you ran a cash balance plan where you explicitly said you were going to do that, people would think you're out of your mind. You know, if you say, okay, well, we're going to have a cash balance plan, we're going to offer them guaranteed 8% return, people say, look, you can't do that. Now, that's in fact what we're doing under the current system, but what the transparency of a cash balance plan causes people to moderate their plans. A third approach, I don't want to go on too long, a third approach is sort of a hybrid, where you have a smaller defined benefit plan coupled with the defined contribution approach. Actually, in California, Governor Jerry Brown just proposed something like this, where part of the retirement would come from a small DB, part from a defined contribution plan, and part from Social Security. So if even California is proposing something like this, it shows which direction we're going in. The state of Utah has gone with a slightly different approach, which could also be called a hybrid, where they have a defined benefit plan, but the maximum contribution from the government is set at 10%. So if the costs go up, it's going to be the employees that will bear that we call marginal cost. So the risk to the taxpayer is limited in that sense. And so it has that element of a defined contribution approach to it, in that the risk is not entirely borne by the government or by the taxpayer. So there's different ways of getting at that. My approach, or my preference, is to have as much transparency as possible. If we want to pay high pension benefits, generous pension benefits to public employees, if that's what people choose, that's fine to do. The problem we have today is we're paying them, but the accounting rules we use make us think we're not paying for them, and that's just not right. Now, when people propose shifting or even thinking about defined contribution plans, you get pushback, and PERS here has done some pushback on that. One of the main criticisms they make is so-called transition costs for defined contribution plans. The idea there is, under current accounting rules for defined benefit pensions, if you have unfunded liabilities from past years, you have 30 years over which to amortize or pay off those unfunded liabilities. If you close a defined benefit plan and start up a new plan, you have a shorter period over which to pay off those unfunded liabilities. You have to speed up your payment, which means that for this transition period, your amortization costs are going to go up. That's what they call the transition cost. Now, there's a certain irony in the sense of the existence of these large unfunded liabilities from the defined benefit plan is being used to argue against shifting to a defined contribution approach where you're not going to accumulate these big unfunded liabilities. So it's a little bit rich to push this. But even in fact, in practice, it doesn't have to be that way. The state of Utah went through this, where they wanted to shift to an approach that limited the liabilities, or limited the exposure to the taxpayer, but they also recognized this transition cost issue. And unlike the studies you'll see from PERS and other pension plans around the country, the actuaries who worked with the folks in Utah were actually helpful to them. They weren't just trying to make a case against reform. They're trying to say, if you want to reform, here's how you can do it. And the answer is that if you close the old plan and start up a new plan, then you have this transition cost issue. If you create a new tier within the existing plan, be it a cash balance approach or something else, then you don't have the transition cost issue. It's a purely an accounting thing. If you package it within the existing plan, then the rules for amortization let you do it over 30 years. If you do the same thing outside the existing plan, then you create the transition cost. It's an accounting-driven, a paper cost. But it is something that policymakers, if they want to get around to this stuff, can do so. So just because people say there are transition costs doesn't mean that you can't reform your system. Before I stop, I just want to touch on one final thing. This is an argument that comes up. It came up this morning where a lot of plans around the country, and I think I work out of Washington, D.C. I do a lot on federal issues, but for the one advantage I have is that when I do the state and local pension stuff, I look at states around the country. And what you find out when you do that is there's essentially a coordinated approach among all the different plans. You get the same talking points coming out of all the different pension plans. If you only live in one state and you pay attention to your own plan, you don't really realize that. But you see the same stuff coming out, the stuff in transition costs, whatever, coming out of all different plans around the country. But there's one final point they like to make, is they try to say there's a huge economic benefit to defined benefit plans. They say, well, we're paying out all this money to retirees in our state, and there's a multiplier that comes out of this. Those retirees spend the money, they give it to other people, and they give it to other people. It creates all this economic activity. And they think that because they use the word multiplier, which economists sometimes use, that the argument is actually going to make sense then. The problem is it doesn't, because this multiplier effect on the economy only exists if you assume that without paying those benefits out, that money would simply disappear. In other words, if let's say we canceled benefits for pensions today, we gave the money back to the taxpayers. Well, those taxpayers would spend it. Then the people they gave it to, they'd spend it again. You'd have a multiplier on that end. For every dollar you pay out that has a multiplier attached to it, there's a negative multiplier for the guy you took it from. So they're counting one side of the equation. This argument of this economic multiplier basically doesn't make sense, because it assumes that if you didn't pay out these benefits, that money would simply disappear into thin air. We know that's not the case. The money would simply do something else. So what we need to do is, growing up, my dad was an accountant. And I thought accounting was the most boring occupation on earth. And I was like, why would you ever want to do this stuff? And what I found, the more time, maybe it's genetic, but the more time I spend on these things, be it on Social Security or pensions or public sector pay issues, how you measure a problem is incredibly important. These accounting rules are hugely important because the way you measure a problem determines how you view it and what you're going to do about it. The way we measure public pension accounting or pension finances today tells you that a plan like PERS has a kind of small but manageable funding problem, and that it could fix the problem by simply investing in riskier assets. If it shifted all its money into stocks and assumed a 10% return on investment, which is reasonable, the plan would probably be fully funded tomorrow. When you look at the problem with realistic accounting rules that economists think make sense, what you find is the underfunding for PERS is a lot bigger than we thought it would be, but also that taking more investment risk isn't going to fix the problem. So it's not, it gives you a viewpoint of how big the problem is and what will and what won't get us out of it. So as arcane and boring as these accounting debates can be, it's extremely important to first get on top of where we are, because that'll tell you where we can go and what we should do in the future. I will stop at that, but certainly I appreciate you taking the time to listen to me, and if you have any questions, I'd be happy to answer them. Thank you very much.